Welcome to the Economist in Your Ear podcast. Have you ever wondered why inflation, that relentless upward march of prices, seems to cling on tighter in some places than others, particularly in countries like the United States? It's a question that keeps economists, policymakers, and, well, pretty much everyone else up at night. The Economist recently published an analysis suggesting that America, along with other English-speaking nations, has what they call the most entrenched inflation among rich countries. They describe it as a kind of stubborn illness, using this really evocative Yiddish phrase, verschleppte Krank.
Right, verschleppte Krank, an illness that just lingers and won't go away easily.
Exactly.
And it's a compelling headline, definitely. They support it with a custom entrenchment score they've developed. This score pulls together, I think, 5 different indicators. Everything from core inflation figures to how often people are even searching for inflation on Google. But here's where it gets really interesting, I think. If we actually dig into the underlying data and maybe bring in some alternative perspectives, the picture becomes, well, far more nuanced. It suggests that America's inflation story might not be quite as straightforward as that headline makes it seem.
Okay, so our mission today is to sort of peel back the layers of this story. We're going to look at the Economist's core arguments, the data points they use, and then, critically compare them with the very latest information we have. The goal is really to give you, the listener, a fuller, more insightful understanding of why some of these perceived differences in inflation persistence might actually be more about how we measure things or maybe specific policy choices, rather than some broad, inherent economic weakness.
Exactly. It's about getting to the heart of what's really driving the numbers.
So let's start by laying out the Economist's case more clearly. They diagnosed this verschleppte Krank, this lingering inflation, using their unique score. What are the key metrics they're looking at?
Well, they focus on core inflation first off. That strips out the volatile food and energy prices, supposedly giving a clearer picture of the underlying trend.
Okay.
Then there are unit labor costs, basically the cost of labor per unit of output. That's a key indicator for wage pressures feeding into prices.
Right.
They also consider inflation dispersion. So that's looking at how many different items across the economy are actually seeing prices go up, not just, one or two big things.
Like how widespread it is.
Precisely. And crucially, inflation expectations, what people think prices are going to do in the future, which can become a self-fulfilling prophecy, of course.
Sure.
And finally, as you mentioned, even Google search behavior related to inflation, sort of as a proxy for public concern or awareness.
And based on combining all of those, their ranking puts the Anglophone countries, particularly Britain and America, right at the top for this entrenched inflation.
Right.
On the flip side, who looks better in their assessment?
Well, France, for instance, comes out with the least entrenched inflation according to their score. And Japan's inflation is described as having, I think the phrase was, a feeble grip. So basically barely registering is an issue there. So in the Economist's view, there's quite a clear linguistic, maybe even cultural divide in how deeply inflation has settled in.
That is a stark contrast. So what reasons do they give for this Anglophone exceptionalism? Why are these English-speaking nations supposedly different?
They highlight a couple of primary drivers. First, they argue there was significantly looser fiscal policy in these countries. Think the U.S., U.K., Canada, Australia between 2022 and 2024 compared to, say, the Euro area.
Right. So more government spending, boosting overall demand.
Exactly. A lot of money sloshing around, potentially pushing prices up.
And the second key factor?
High immigration rates. The Economist suggests that, at least in the short run, a large influx of new residents could push up prices, especially for things like housing, just due to the increased demand. For America specifically, they point to continued government spending, maybe the lingering threat of tariffs from President Trump's policies stirring things up, and notably, public expectations for higher prices. They even cite a specific figure saying Americans expect prices to rise by 5.5% over the coming year, which they claim is higher than any other country.
Okay, so that's the Economist's diagnosis. Entrenched inflation, especially in places like the US and UK, driven by loose fiscal policy, immigration, and high expectations. But now let's start peeling back those layers. Does the most recent data, let's say looking at August 2025, truly support this claim of America being the clear outlier, the worst in class, so to speak?
Yeah, this is where it gets really fascinating, because what often gets missed in these big international comparisons is how the choices in measurement can subtly, or sometimes not so subtly, stack the deck.
How so?
Well, Take the main U.S. inflation measure, the Consumer Price Index, or CPI. That's the one you hear about most often. It includes owner-occupied housing costs through something called OER.
Owner's equivalent rent, right. An estimate of what homeowners would pay to rent their own place.
Precisely. It's an imputed rent. Now, here's the kicker. The euro area's main measure, the HICP Harmonized Index of Consumer Prices, it excludes owner-occupied housing costs entirely.
Ah, okay. Big difference.
Huge difference. Because shelter costs actual rents, and this OER component are a massive part of the U.S. CPI. And they tend to be sticky, slow-moving. So this one methodological difference can make American inflation look stickier and more dispersed, even if underlying price pressures are easing elsewhere, simply because of how we measure housing.
So the numbers might tell different stories depending on which measure you pick.
Exactly. Just for context, the U.S. July CPI came in at 2.7% year over year, with core CPI at 3.1%. Okay, still above target. But the Federal Reserve's preferred measure, which is core PCE, Personal Consumption Expenditures Price Index, it's broader and handles housing differently. That was 2.8% in June. And the Dallas Fed's trimmed mean PCE, which filters out the biggest price swings each month, was even cooler at 2.7%. Those numbers are considerably closer to the Fed's 2% target than the CPI alone might suggest.
That's a really crucial distinction. So if measurement matters that much, it makes you question other parts of the argument too. Like, are American inflation expectations consistently the worst, as that 5.5% figure implied?
You've absolutely hit on a critical point there.
Right.
While The Economist might reference a high number often that comes from the University of Michigan's preliminary survey for one-year expectations, which did sit higher recently, around 4.9%, I think, for August.
Okay.
And that survey can be quite volatile month to month. But other important surveys tell a much more complex story. For instance, the New York Fed's survey of consumer expectations, looking at July data, actually shows one-year expectations significantly lower at 3.1%.
Wow, that's a big gap from 4.9% or 5.5%.
It really is. And their five-year expectations were even cooler at 2.9%. Meanwhile, euro area consumers, for comparison, they see 2.6% for one-year expectations. So this widespread across different reputable surveys really undercuts any single alarming 5.5% narrative. It shows that measurement choice truly matters, even for something like expectations. It's just not a uniform picture of American consumers bracing for runaway prices.
That's fascinating. Okay, what about the idea that soaring labor costs are the main driver of this entrenchment, that there's some kind of unique U.S. wage price spiral happening? The Economist includes unit labor costs in its score.
Right. And if the U.S.'s worst story was primarily about wage costs, you'd expect to see unit labor costs, rocketing upwards here compared to elsewhere.
Makes sense.
However, the latest actual U.S. data for the second quarter showed unit labor costs rising at just a 1.6% annualized rate.
1.6%. That sounds pretty tame.
It's hardly runaway, right? It suggests that productivity gains are actually doing a decent job of offsetting wage increases, preventing them from broadly pushing up prices across the economy. Now, if we look internationally, the UK's core inflation does remain quite sticky. It was around 4.3% year over year in June. France's core is much lower, roughly 1.5%. So while The Economist might be right about a regional pattern, maybe Anglophone countries having slightly more persistent core inflation overall, the specific claim that America is a clear outlier because of labor cost dynamics just isn't fully supported by this recent data. Wages aren't the unique problem here.
Okay, another pillar of their argument was loose fiscal policy. The idea that the U.S. government still has its foot on the fiscal pedal really hard, is that still accurate?
Well, it's really crucial here to distinguish between two things: the absolute size of the budget deficit and what economists call the fiscal impulse.
Okay, what's the difference?
The deficit is the total amount the government spends beyond its tax revenue in a year. The fiscal impulse, though, is the change in that spending or taxation level from one year to the next. It's about whether policy is adding new demand to the economy.
Got it. So is the U.S. adding a lot of new demand?
Well, yes, the U.S. federal deficit is still huge in absolute terms, around $1.9 trillion projected for fiscal year 2025. That's a big number. But compared to fiscal year 2024, it's actually expected to be broadly flat, maybe even slightly lower depending on the final numbers.
Ah, so the impulse isn't really loosening further.
Exactly. It's more stable than continuing to accelerate. Now, contrast that with the euro area, where fiscal policy is actually tightening modestly right now. Governments there are pulling back a bit.
Yeah.
So if the Anglophone exceptionalism argument relies heavily on ongoing fiscal loosening in places like the U.S., well, that might be an overstatement given the current trajectory. The big boost was earlier.
Right, that context matters. Okay, and what about tariffs? The Economist highlighted those for the U.S., suggesting they're stoking fears of new price hikes. How significant are they right now?
Tariffs are definitely inflationary, no question.
Yeah.
When you tax imported goods, those costs usually get passed on to consumers one way or another.
Sure.
However, their impact can be kind of lumpy. It depends on timing and specific goods. And actually, just recently, on August 12th, the White House extended the truce on further China tariffs by another 90 days.
Oh, okay. So that paused another potential price shock.
It did. For now, it prevents another lurch higher in duties. Now, existing tariffs obviously still add some cost pressure at the margin, but the critical point here, I think, is that the near-term risk from tariffs is mainly to goods prices.
Right.
And as we'll discuss more, the real persistence, the real stickiness in U.S. inflation right now is overwhelmingly in services, not goods. Goods inflation has actually cooled quite a bit.
So tariffs might be a factor, but maybe not the primary driver of the specific kind of inflation stickiness we're seeing now.
That seems likely, yeah. It's not hitting the core problem area directly.
Okay, and finally, the role of immigration. The Economist mentioned it pushing up prices. Is that a simple one-way street? High immigration equals higher inflation?
It's definitely not that simple. High net migration, and it was exceptionally high in 2024, maybe 2.6 to 2.8 million people. It can certainly push up local rents and housing costs in the short term. That's basic supply and demand, especially in cities where new arrivals tend to concentrate.
Right.
However, and this is big, however, immigrants also significantly expand the labor supply. They fill jobs, often in sectors facing shortages like healthcare or construction. This influx of workers can actually ease economy-wide wage pressures.
Ah, so it cuts both ways. Demand pressure on housing, but supply relief for labor.
Exactly. It's a much more complex dynamic. And looking ahead, border encounters actually plunged this summer. So any inflationary pressure purely from the rate of new arrivals is likely diminishing as we head into 2026. Of course, that also means the potential economic growth boost and the labor supply relief from high migration will also start to fade. It's a dynamic factor with effects on both demand and supply.
Okay, so putting all these pieces together, what does this mean for you, the listener? How should we really interpret the U.S. inflation story right now? It sounds like it's less about being generally worst in class and maybe more about some specific, perhaps less obvious factors driving the U.S. numbers.
Precisely. I think the core takeaway here is that the real stickiness, the Fahrschlepterkrank, if you will, in U.S. inflation, actually lives predominantly in the services sector, especially shelter that combination of actual rent and the owner's equivalent rent we talked about, plus maybe a bit from areas like medical care and travel services.
And the measurement of shelter is key here.
It's absolutely central. The fact that shelter has such a heavy weight in our main inflation measure, the core CPI, and the way it's measured lags real-time market rents by several months. That combination keeps the official core CPI figures looking stubbornly higher than other measures.
Like the core PCE the Fed prefers.
Exactly. Core PCE or that trimmed mean PCE, which are already looking much closer to the Fed's 2% target. So a significant part of the entrenched inflation story in the U.S. is actually an accounting reality, a statistical quirk related to housing measurement, not solely a sign of a broad macroeconomy running universally too hot.
That's a really crucial distinction. It shifts the focus quite dramatically. So if these are the true drivers, mainly services, heavily influenced by shelter measurement, what can actually be done, and what are the risks looking ahead?
Well, if we connect this to the bigger picture, while the U.S. might not clearly be worst in class when you adjust for measurement, it is arguably more exposed to certain kinds of policy-driven price shocks than, say, France or Japan right now. So if the goal is less entrenched inflation, then de-risking policy seems absolutely key.
De-risking policy, what does that mean in practice?
Well, for instance, on the trade front, it means holding tariff levels steady, or ideally even lowering them where possible. Avoiding fresh, broad-based levies is probably one of the fastest ways to ensure goods inflation stays cool, even if goods aren't the main source of stickiness right now. It prevents adding new fuel to the fire.
Okay, makes sense. And given the huge impact of housing you described, what about tackling shelter costs more directly?
Accelerating shelter disinflation is perhaps the single most crucial thing for getting those headline CPI numbers down. And that means tackling the supply side.
Like building more houses.
Exactly. Policies like serious zoning reform to make it easier to build, especially multifamily housing, speeding up approvals, maybe even looking at tweaks to how rent data gets incorporated into the official indices to make them more timely. because shelter's index dynamics really dominate the U.S. CPI optics right now, making inflation look higher than it might feel elsewhere in the economy. And remember, with unit labor costs looking pretty benign currently, investing in broader supply-side productivity, thinking about things like streamlining permits, upgrading power grids, improving ports, alongside boosting housing supply, probably does far more for long-term de-entrenchment than just trying to blunt demand through, say, higher interest rates alone. It's about building capacity.
That really reframes the conversation, doesn't it? Moving away from just a general economic malaise picture towards much more targeted structural interventions. So for you, the listener, the takeaway seems to be it's not just about asking if inflation is high, but really digging into why it's high, where it's concentrated, and understanding what specific levers, some perhaps surprising, like housing measurement or zoning laws, could actually bring it down sustainably.
Exactly. It's less like a widespread economic fever and maybe more like a localized stubborn ache that needs a much more precise kind of treatment.
Thanks for listening. Follow us so you won't miss the latest from The Economist magazine every day. And don't forget to like, comment, and share.